When I talk about spotting high probability setups, I'm not talking about clever tricks or fancy indicators. I'm talking about the quiet work of waiting, watching, and recognizing when the market is finally ready to do what it's been hinting at all along. Trading, as I learned it, is mostly about patience. Most people lose money not because they're dumb, but because they can't sit still. Have you noticed how hard it is to do nothing when prices are moving? A high probability setup doesn't shout at you. It doesn't beg you to trade. It stands there calmly, like a man who knows his own strength. You see it only after you've trained your eye to ignore everything else. The market spends most of its time going nowhere important, chewing up impatient traders. Then, once in a while, it lines things up. That's when the professional pays attention. Do you really think money is made by trading all day? I always believed the big money comes from the big swing, not from being busy. A stock, or any market, must be under accumulation or distribution before it can move in a meaningful way. Prices don't leap without a reason. They build pressure, like steam in a boiler. A high probability setup is simply the moment when that pressure is ready to release. Your job isn't to predict it. Your job is to recognize it when it's already happening. Can you see the difference? One of the first things I look for is direction. If the market has no clear trend, I have no clear opinion. I never argue with the tape. If prices are making higher highs and higher lows, I know the line of least resistance is up. If they're making lower lows, the path is down. Everything else is noise. High probability trades align with the main trend, not against it. Why fight the strongest force in the room? Then comes the base. Strong moves don't start from the middle of nowhere. They start after a period of rest, when weak hands have been shaken out and strong hands are quietly building positions. This is where most traders get bored and wander off. They want action, not preparation. But preparation is where the edge is born. When you see a tight range after a long decline, or calm trading after a steady advance, you're looking at potential energy. Are you patient enough to wait for it to turn into kinetic energy? Volume tells its own story if you're willing to listen. When price moves with expanding volume, it means participation. It means agreement. When price drifts on low volume, it means indifference. High probability setups usually show their hand before the big move begins. You'll see volume pick up slightly on advances and dry up on pullbacks in an uptrend. That's not an accident. That's professional money at work. Do you watch volume, or do you just stare at price? Another thing I learned the hard way is that the best trades feel uncomfortable at first. When a stock breaks out of a long base, it often looks too high to the beginner. When it breaks down after distribution, it looks too low, but the market doesn't care about your feelings. High probability setups often require you to buy strength or sell weakness. That goes against human nature. Are you trading your opinions, or are you trading what's actually happening? Risk comes before reward. That's not a slogan, it's survival. A true high probability setup offers a clear point where you know you're wrong. If you don't know where you'll get out before you get in, you're not trading. You're gambling. I always wanted my losses small and my wins allowed to grow. That asymmetry is where fortunes are made over time. How many times have you stayed in a bad trade just because you didn't want to admit you were wrong? Money management is the silent partner in every good setup. Even the best-looking trade can fail. The market owes you nothing. That's why position size matters. I never risked so much that one trade could hurt my confidence or cloud my judgment. A calm mind reads the tape better than a desperate one. High probability trading isn't about bravado. It's about staying in the game long enough for probabilities to work. Are you betting the farm, or are you building it brick by brick? Another thing most people miss is timing. Being right too early can feel exactly like being wrong. A setup isn't complete just because it looks good on paper. It needs confirmation. Breakouts should break. Trends should follow through. If they don't, step aside. There's no shame in waiting for proof. The market will always give another opportunity. Why rush into a trade that hasn't proven itself yet? Your mindset shapes how you see setups. If you're desperate to make money, everything will look like a high probability trade. If you're calm and disciplined, only the best ones will stand out. I always said the market is a mirror. It reflects your weaknesses faster than your strengths. High probability trading requires emotional balance, not excitement. Can you stay detached when everyone else is emotional? Wealth in trading isn't built on one big score. It's built on consistency, on doing the right thing over and over, even when it's boring. The trader who waits for high probability setups trades less but earns more. He doesn't chase tips or rumors. He studies price, volume, and behavior. He trusts his rules more than his hopes. Are you willing to be that kind of trader, or do you just want action? When you truly understand high probability setups, you stop trying to outsmart the market. You let it show you its hand. You act when the odds are clearly tilted in your favor, and you stand aside when they're not. That discipline is rare, and that's why it's valuable. Most people won't do it. They can't wait. They can't listen. And that's where the real work quietly begins. High probability setups align with the main trend, never against it, and that idea cost me a lot of money before it ever made me any. Early on, I thought I was smarter than the market. I believed that if something had gone up too far, it had to come down, and if it had fallen hard, it had to bounce. That kind of thinking sounds reasonable, doesn't it? It appeals to logic, and logic feels safe. But the market doesn't reward what feels safe. It rewards what is true. The trend is simply the market's verdict. It's the sum total of all opinions, all money, all fear and hope, expressed in one direction. When prices are moving steadily upward, that's not an accident. It means demand is stronger than supply, and it will stay that way longer than most people expect. Fighting that is like standing in front of a moving train and insisting it should stop because it's gone far enough. How often does that work out? A high probability setup doesn't come from guessing where the trend will end. It comes from recognizing that the trend is already in force and positioning yourself in harmony with it. I never made consistent money trying to pick tops or bottoms. I made money sitting tight during corrections and entering when the main movement resumed. That required swallowing my pride. It meant admitting I didn't need to be the first one in. Do you really need to catch the very beginning to make money? Trends have rhythm. They move, they pause, and then they move again. Those pauses are not signs of weakness. They're signs of digestion. The public often mistakes a normal pullback in an uptrend for the start of a collapse. Professionals see it as an opportunity. High probability setups often appear right there, in the quiet moments when price pulls back but refuses to break down. That refusal tells you more than any indicator ever could. Are you watching what price refuses to do? When you trade with the trend, you're not relying on hope. You're relying on momentum that's already proven itself. The market has already shown you where it wants to go. Your job is to stop arguing and start listening. Counter-trend trades can win, but they require perfect timing and iron nerves. Trend-aligned trades forgive small mistakes. They give you time to think. That forgiveness is part of their probability. Why choose the harder path when the easier one is right in front of you? Another thing about trends is that they persist because of human behavior. Fear and greed don't switch off overnight. When institutions are accumulating, they don't finish in a day. They buy over time, quietly pushing price higher in waves. When distribution begins, it also takes time. That's why trends last longer than logic suggests. A high probability trader respects that persistence. He doesn't assume today will be different just because it feels extreme. Have you noticed how extremes tend to extend before they end? Aligning with the trend also simplifies decision-making. Instead of asking 100 questions, you ask one, is the market making progress in the same direction? If the answer is yes, you look for entries in that direction only. That discipline filters out bad trades before they ever reach your account. Most losses come from unnecessary trades. High probability often means fewer trades, not more. Can you accept making less decisions to make better ones? Risk management becomes clearer when you trade with the trend. In an uptrend, your stop belongs below the structure that supports the trend. In a downtrend, it belongs above resistance. The market itself defines where you're wrong. That clarity is part of what makes the setup high probability. You're not guessing where to exit, you're responding to the market's own signals. Isn't it easier to stay disciplined when the rules are simple? I learned that the urge to trade against the trend often comes from ego. It feels good to be right when everyone else is wrong. But trading isn't about being right, it's about making money and keeping it. The market doesn't pay extra for bravery or cleverness. It pays for alignment. When you let go of the need to outthink the crowd and instead flow with it, your results change. Have you ever noticed how calm trading feels when you stop trying to prove something? High probability setups also demand patience within the trend. Just because the direction is clear doesn't mean every moment is tradable. Chasing price after it's already run invites trouble. The best opportunities appear after pullbacks, consolidations, or brief shakeouts that test conviction. These moments scare weak hands and reward prepared ones. But you have to be watching, not reacting late. Are you studying the trend, or are you chasing its shadow? There's also a psychological comfort in trading with the trend that most people underestimate. When price moves in your favor quickly, it reinforces discipline. It allows you to hold winners longer instead of grabbing small profits out of fear. Trend-aligned trades teach you how to sit still, which is one of the most profitable skills a trader can learn. Sitting still is harder than clicking a button. Can you let a good trade work without interfering? Over time, you begin to trust trends more than opinions. News becomes secondary. Predictions fade into the background. All that matters is what price is doing now compared to what it was doing before. That focus sharpens your instincts. You stop looking for excitement and start looking for confirmation. High probability trading becomes less about action and more about alignment. And alignment is a quiet thing. It doesn't rush you, it doesn't shout. It just waits for you to notice it and act in step with it, while the rest of the crowd is busy trying to call the turn. The market moves only when it's ready, not when you are, and that lesson is one every trader pays for in time or money, usually both. When I first started, I believed desire had something to do with results. If I wanted a trade badly enough, if I watched it closely enough, somehow the market would respond. That illusion doesn't last long. The market doesn't know you're there, and it certainly doesn't care how eager you are. Have you ever noticed how the moment you need a trade to work is usually the moment it doesn't? The truth is, most of the time the market is inactive in any meaningful sense. Prices move, yes, but they move without purpose. They drift, they fluctuate, they create motion without opportunity. That's where impatient traders get trapped. They confuse movement with readiness. Just because something is ticking doesn't mean it's tradable. I learned that waiting for the market to be ready was far more profitable than trying to make something happen. How often have you traded simply because you didn't want to wait? Readiness in the market shows itself quietly. It's not excitement, it's structure. It's when price has done enough work to justify a move. Before a real advance or decline, there is preparation. Weak hands are pushed out, strong hands take their place, and the market tightens. This process takes time, and time is what most traders can't tolerate. They feel unproductive when they're not trading. But inactivity is part of the job. Do you see waiting as wasted time, or as part of your edge? I found that the market often looks most tempting right before it disappoints you. That's when your emotions are ahead of reality. You see a few bars move, you imagine the rest, and you act before the market has committed. When the market is truly ready, you don't have to imagine much. Things begin to line up. Price behaves differently. Reactions become shallow, follow-through becomes easier. The tape feels heavier in one direction. Have you felt that difference, or are you always trying to force clarity? One of the hardest habits to break is trading on your own schedule. You sit down, you decide it's time to make money, and you expect the market to cooperate. But the market has its own clock. It speeds up and slows down without consulting you. When I stopped trying to impose my timing on it, my results improved. High probability opportunities appeared when I was willing to wait for them, not when I demanded them. Are you trading the market's timing, or your own impatience. There's also a subtle arrogance in thinking the market should move just because conditions look right to you. You might see a perfect pattern, a clean level, a logical setup, and nothing happens. That's not the market being wrong. That's the market not being ready. Patterns don't move prices, participation does. Until enough money agrees, nothing meaningful will occur. Accepting that keeps you from overtrading. Can you accept being early and doing nothing instead of being early and losing money? When the market is ready, it often moves faster than expected. That's another reason waiting pays. Traders who jump in early spend their energy surviving noise. Traders who wait enter when the move has already begun, when uncertainty has been reduced. They might miss the first piece, but they catch the part that matters. I always preferred to take the middle of the move, where probability lies. Why chase the start when the confirmation is where the money is? Readiness also shows in how the market reacts to bad news or good news. In a market that's not ready, news causes sharp reactions that quickly fade. In a market that is ready, news barely matters because price was already prepared to move. That's a powerful clue if you're paying attention. Price that refuses to fall on bad news or refuses to rise on good news is telling you something. Are you listening to the reaction or just the headline? The discipline to wait for readiness protects your capital, but it also protects your mindset. Overtrading wears you down. It fills your head with doubt and frustration. Waiting keeps your judgment clear. You see the market more objectively when you're not emotionally invested in every tick. High probability trading is as much about preserving mental energy as financial capital. How sharp can your decisions really be if you're exhausted from constant action? Another thing I noticed is that readiness is often obvious in hindsight, but subtle in real time. That's why rules matter. You need standards that tell you when the market has done enough. Without them, your emotions will fill the gap. You'll trade possibilities instead of probabilities. The market doesn't reward possibility. It rewards confirmation. Learning to wait for confirmation is learning to trade like a professional. Are your rules built to protect you from boredom? The market will always offer more opportunities than you can take. That's not the problem. The problem is choosing which ones deserve your money. Readiness is the filter. If the market isn't ready, you don't need to be involved. There's no prize for participation. The only score that matters is the balance in your account over time. Everything else is noise. Can you walk away from a screen knowing that doing nothing was the right decision? When you truly accept that the market moves only when it's ready, your behavior changes. You stop chasing. You stop predicting. You stop feeling pressure to act. You become selective. You let price come to you. That shift doesn't happen overnight. It comes from watching missed trades that saved you money and taking trades that worked because you waited. Slowly, trust replaces urgency. And once urgency is gone, you start to see the market more clearly. Strength should be bought, weakness respected, not argued with, and that lesson runs straight against human instinct. Most people are wired to look for bargains, to feel clever by buying something that looks cheap or selling something that looks expensive. I was no different at the beginning. I thought a stock that had already risen a great deal must be nearing its end, and one that had fallen hard had surely seen the worst of it. That kind of thinking feels sensible, doesn't it? But the market is not a department store, and prices are not labels waiting to be corrected. Strength in the market is not an accident. It's evidence. It's proof that demand is overwhelming supply, and that someone with size, patience, and conviction is at work. When prices keep pushing higher despite reasons to fall, that's not excess. It's power. Weakness is the opposite. It's not an invitation to argue. It's a warning that something is wrong beneath the surface. The market is speaking plainly, but most traders talk back instead of listening. Have you ever noticed how arguing with price feels personal, as if the market is challenging your intelligence? Buying strength requires a shift in mindset. You have to stop thinking in terms of what something should be worth and start thinking in terms of what it's doing right now. A stock making new highs is not expensive by definition. It's strong. It's being accumulated. Someone is willing to pay higher prices today than yesterday. That willingness is the fuel of trends. When you buy strength, you are aligning yourself with that fuel instead of standing in its way. Why insist on being contrarian when momentum is offering cooperation? Weakness deserves respect because it represents distribution, uncertainty, or outright trouble. Prices falling easily are telling you that sellers are in control. That doesn't mean you must rush to short, but it does mean you should step aside or protect yourself. Trying to buy weakness because it looks oversold is one of the fastest ways to tie up capital and patience. Weak markets can always get weaker. I learned that the hard way. How many times have you bought something simply because it couldn't possibly go any lower? The market does not reward sympathy. It doesn't care that a stock has fallen far, that it used to be higher, or that it looks cheap compared to last year. Those are human judgments, not market facts. The only fact that matters is price behavior. Strength is price behaving well. Weakness is price behaving poorly. High probability trading comes from accepting those definitions without debate. Can you accept what the market is doing without trying to correct it? Buying strength also helps solve one of the biggest problems traders face: hesitation. When you buy weakness, you're often early. You wait, you hope, you justify. When you buy strength, confirmation is already present. The trade works quickly or it tells you you're wrong. That clarity is valuable. It keeps losses small and confidence intact. Strong markets don't need excuses to move. They move because they can. Wouldn't you rather trade something that wants to go your way? There's a fear many traders have of buying at highs. They imagine being the last buyer before the fall. That fear is understandable, but it's misplaced. Most major moves spend a lot of time making new highs. That's how trends unfold. The real danger isn't buying highs, it's buying weakness and pretending it's strength. High probability traders don't buy just any high. They buy constructive strength. Strength that comes after preparation, consolidation, and resistance being overcome. Are you afraid of price, or are you afraid of being wrong? Respecting weakness doesn't mean predicting collapse. It means acknowledging risk. In weak markets, rallies fail. Support breaks easily. Good news is ignored. Those are not conditions for optimism. Standing aside is a position. Capital preserved during weak conditions is capital available when strength returns. Many traders feel compelled to act, as if inactivity were a failure. In reality, forcing trades in weak environments is what causes the real damage. Can you respect weakness enough to do nothing? Strength also tends to attract strength. When a market proves itself, more participants take notice. That creates follow-through. Weakness does the opposite. It repels interest. Liquidity dries up, volatility increases, and emotions dominate. High probability setups live where participation is expanding, not shrinking. That's why strength is a friend. It brings company. Weakness leaves you alone with your hopes. Which environment do you think offers better odds? I found that once I stopped trying to be clever and started buying strength, my trading became simpler. I no longer needed elaborate explanations. The market was either acting right or it wasn't. If it was strong, I looked for ways to participate with defined risk. If it was weak, I stayed cautious or stepped aside. This simplicity wasn't limiting. It was freeing. It removed a lot of internal conflict. Have you noticed how much mental energy is wasted justifying weak trades? There's also a lesson about ego buried in this principle. Buying weakness often feeds the ego. You feel bold. You feel early. Buying strength requires humility. You're admitting the market knows more than you do. That humility is expensive at first because it costs you your opinions, but over time, it pays dividends. The market doesn't reward ego, it punishes it. Strength, following traders survive long enough to compound. Have you ever asked yourself whether your trades are driven by opportunity or by the need to feel smart? When you consistently buy strength and respect weakness, your results start to reflect probability rather than hope. You begin to notice how trends carry further than expected, how strong instruments forgive poor entries, how weak ones punish even good intentions. These observations don't come from theory, they come from experience. Over time, You stop asking whether something is cheap or expensive and start asking whether it's acting right. That single shift changes how you see every chart, every pullback, every breakout, every failure, until price behavior becomes your primary language, and you find yourself less interested in arguing with the market and more interested in aligning with it, watching strength emerge, watching weakness reveal itself, and choosing where to place your capital based on what the market is actually proving rather than what you think it out to do. A real setup always defines risk before it promises reward, and that idea is simple enough to say, but hard enough to live by that most traders never truly adopt it. When I started, I was focused almost entirely on how much I could make. That's where the excitement was. Profit was the dream, and risk was an afterthought. I assumed I could figure it out later, once the trade started working. That way of thinking didn't just cost me money, it cost me clarity. Have you ever entered a trade without knowing exactly where you'd get out if it went wrong? Risk is not something you manage after you enter. It's something you accept before you commit a single dollar. If you don't know where you're wrong, you don't know where you're right. The market doesn't move in straight lines, and even the best-looking setups fail. A high probability trade doesn't mean a guaranteed outcome. It means the odds are tilted slightly in your favor, nothing more. That's why defining risk is non-negotiable. Without it, probability means nothing. Are you trading probabilities, or are you relying on hope to save you? Every real setup has a line in the sand, a price level that invalidates the idea. That level is not arbitrary. It comes from market structure, from behavior that either continues or breaks. When price crosses that line, the premise is gone. Staying in after that is no longer trading, it's negotiating with reality. I learned that the hard way by holding losers and convincing myself they were temporary. The market has no interest in your explanations. Have you noticed how quickly small losses turn into large ones when you refuse to define them? Reward, on the other hand, is uncertain by nature. You can estimate it, but you can't control it. The market will give what it gives. Risk is the only part of the trade you can control completely. That's why professionals obsess over it. They don't need big wins every time. They need small losses when they're wrong and room to breathe when they're right. Over time, that math works. But it only works if risk is respected first. Why focus on the one thing you can't control and ignore the one thing you can? A setup that doesn't clearly define risk isn't a setup at all. It's a story. Stories are seductive. They make sense. They appeal to imagination. But the market doesn't trade stories. It trades behavior. If you can't point to a price that proves your idea wrong, then your idea isn't grounded in the market. It's grounded in opinion. High probability trading begins when opinions take a back seat to structure. Can you tell the difference between a clean setup and a convincing narrative? I also found that defining risk in advance changes how you feel in the trade. When you know the worst-case scenario, you stop reacting to every fluctuation. Noise loses its power. You're no longer surprised by normal pullbacks because you planned for them. That emotional stability is not a luxury, it's a requirement. Without it, even good setups become unbearable. How steady can your decisions be if you're constantly afraid of losing more than you expected? Another mistake I made early on was adjusting risk to fit my desire for reward. I'd see a big potential move, and then stretch my stop to justify staying in. That's backwards. Risk should be defined by the market, not by your profit target. When you let potential reward dictate risk, you're bending reality to fit desire. That always ends the same way. The market enforces its rules whether you respect them or not. Have you ever widened a stop just to avoid being wrong? A properly defined risk also dictates position size. If the risk is large, the size must be small. If the risk is small, the size can be larger. That relationship keeps losses manageable and consistent. Many traders blow up not because they're wrong too often, but because they're wrong too big. They take the same size on every trade regardless of risk. That's not confidence, it's carelessness. Do you size your trades based on conviction or based on actual risk? There's a psychological relief that comes from accepting risk up front. Once you accept it, The market can't threaten you with it anymore. You've already agreed to the worst case. That agreement frees you to think clearly. You're no longer bargaining with price. You're observing it. That clarity allows you to let winners run instead of cutting them short out of fear. Ironically, accepting loss makes it easier to make money. Have you noticed how fear disappears once risk is defined? High probability setups often look boring from the outside because so much of the excitement has been removed. The risk is known. The entry is deliberate. The exit is planned. There's no drama, no thrill of improvisation, but that's exactly why they work. Trading is not a performance. It's a process. Processes don't rely on emotion. They rely on repetition. Can you commit to a process that removes excitement in exchange for consistency? Over time, you begin to see that reward takes care of itself if risk is handled correctly. You stop chasing home runs and start collecting solid results. You stop needing to be right and start needing to be disciplined. The market rewards that shift slowly but surely. Each trade becomes just one in a long series, not a referendum on your ability. That perspective changes everything. You stop trading to prove something and start trading to execute well.